Welcome, to Beyond the Fill. This is a series that we put together really based off the recommendation of one of our shareholders out in the Northeast. He tapped us on the shoulder and said, "Hey, you really need to put together a series, that showcases all the opportunities that are available, to community pharmacy owners." So we did, and we called it Beyond the Fill so that it would coincide with the theme from our conference at Apex that many of you went to. And I don't need to tell you this, but the environment is rapidly changing right now. But the good part about it is there's all these new and exciting paths, for independent pharmacy. But there's, I think, two very important things that need to be called out. One, you need to have the recognition and awareness that these things exist. And two, and more importantly, you got to capitalize, on the opportunity. You must act, because some of these things won't last forever. And that's really what this series is about, is showcasing the opportunities and putting together a plan to act on them. So for those of you who don't know me, my name is Nathan Rawls. I'm the Vice President National Accounts. I have been with American Pharmacies for 13 years now, and it has been an absolute privilege and an honor, to serve you. So if you remember from American Pharmacies, I thank you, for your commitment to the organization. And if you're a guest, I highly consider that you think about joining, because you're not going to find a more passionate and dedicated group than the folks that we have working at AP. They are truly 100% committed to fulfilling our mission statement, which is to protect, defend, enhance the business model of retail pharmacy. And I'm real proud of that, because this organization is constructed to be a force of good. And we believe in advocacy. We've got a team that works tirelessly, to be agents of change. And we have passed over 20 bills, in state legislatures all over the country. And we now, a couple of years ago, established offices and a lobby firm in Washington, D.C. So we fought the tough legal battles. We continue to negotiate the most competitive economics with our wholesale partner. And now our clinical services team, they're in the process of turning over every stone, to look for new programs that are going to make your pharmacies more profitable. And a lot of times when you're out there and you're searching for a new company or a partner, there's one thing you better look for, and that's a common culture. And that's what we found with Sykes and Company. I've had the pleasure of knowing Scotty and his team, for many years. And I've always been, incredibly impressed, Scotty, with your ability to evolve, as an organization. I think you guys recognized early on, the need to teach pharmacy owners the fundamentals of accounting. But you have a unique perspective. I was thinking about this. You're reviewing financials from pharmacy owners all across the country, all different walks of life. And I think you can clearly see, the correlation between diversification and profitability. And so I've kind of watched your company, evolve from being an accounting firm to what I consider it to be a true pharmacy consulting firm. So I'm very much looking forward, to reviewing the KPIs. Always, it's a lot of fun to see the benchmarking aspect, where you rank amongst your peers and what they're doing that's working. And I'm also really interested in hearing about the tax benefits of the big, beautiful bill, because I know there's numerous, aspects of the bill that are going to be very advantageous, to community pharmacy owners. So I want to thank you for being here today, providing the education and what you do for independent pharmacies, because you're filling a great need. And so with that, introduce Scotty Sykes.
All right. Thank you, Nathan. Appreciate those kind words. Yes, so our firm has been doing pharmacy work for about 40 years now. And it's literally all we do. So we eat, sleep, and breathe this stuff. We're talking to pharmacy owners day in and day out, looking at pharmacy numbers every single day. And that's all kinds of pharmacies, not just retail, compounding, infusion, DME, you name it. We're involved in it. So we do have a breadth of knowledge here in this space, and we love it, and it's our mission to help as many pharmacies as we possibly can. So So I certainly appreciate, again, the kind words and this opportunity to speak with you all today on some important topics. So we do have a little bit about me. You can read that at your own time. Disclosure, definitely speak with your own advisors. I'm going to be covering some kind of unique areas of the tax law. So you do need to speak with your own advisors on what that means for you and your unique situation. So just be aware of that. Some learning objectives. So, we're going to go over the one big beautiful bill. We're going to go over some accounting fundamentals, if you will, key performance indicators, diversified revenue, and some some examples along the way. So, just starting off here, right now in the market, we've been saying this for a long time. Pharmacies really needed to start to diversify revenue and get away from just the prescription model, and add different types of revenue opportunities, cash-based revenues, whether that's compounding, and the list is extensive in terms of diversified revenue. I know the NCPA has quite a long list on their website of different things, but some of the ones you typically see: compounding, long-term care at home, 340B opportunities. If you can find a 340B opportunity that is a fair opportunity, because you can get into a 340B trap if you're not sure what you're signing. But if you can get into a good 340B opportunity that's fair for the covered entity and yourself, it can be a game changer for a pharmacy. So, there's a whole list of diversified revenue opportunities, like I said, but it's, you have to do that. You have to find something in your community that's going to set you apart a little bit. You guys have a lot of traffic coming into the pharmacy. There's a lot of opportunities for different areas of service. But the traditional, fill and script only model is tough. And, if you want to exceed averages and, really be profitable, you have to look at these other areas. And that's what we're seeing in the industry. I mean, we're seeing the pharmacies that are doing that, are really separating themselves from the pack. And they are the community leaders, healthcare leaders in their communities. And so, the wellness centers, if you will, of their communities. And that's really kind of I think long term where pharmacy is gonna be, and with the clinical type services and things like that. So go ahead, if you're not already doing that, you need to start, in my opinion, kind of bracing yourself to make a change and shift your business model to some degree. All along, at the same time, we're all going to be advocating and fighting that the PBMs can, pay a fair reimbursement as they should. So it's unfortunate that this is the way it is, but it's the game we're in. So that's just the reality. The one big beautiful bill, a lot of new opportunities, and just real quick on the summary. Had this bill not passed, tax rates were going to be going up starting next year, and it would have been, I can't even begin to explain how detrimental that would have been for pharmacies. We're talking tax rates, tax brackets going up. We're talking about the QBI deduction going away. We're talking accrual accounting being back in play for paying taxes. In other words, you adjudicate a script, you don't get paid till January, but you're still paying tax on that adjudicated script, the receivable, if you will, in December. So accruing your revenues would have added more tax, even though you hadn't been paid yet. So I mean, we're talking big deal. And so from a tax standpoint, this bill is absolutely a lifesaver for pharmacy to continue and enhance some of these tax benefits that since the Tax Cuts and Jobs Act. Let's see. Of course, when we're talking about the UBA, there's a lot of planning that goes into this. And the planning starts now. So, you need to be speaking with your CPAs, your advisors now on the planning for your tax liability in April. because once you get to the end of the year or after the end of the year, some of the things you want to do, maybe it may be too late. Some things you need to put in place and implement today or before the end of the year. So you need to start having these conversations now with the CPA. And it's all about being proactive here. Nobody likes a phone call on April 15th saying, hey, I need a check for $50,000 or what have you. So proactive planning is the difference maker. Now, how you get to proactive planning is going to be the fundamentals. So that's the accounting fundamentals. So, not only are these fundamental accounting numbers important for tax reasons, because you can know exactly what's going on, you can plan and project out the rest of the year and do different scenarios and things like that. But it's also very, very key because it's going to allow you to know exactly, again, what's going on, how to manage those areas that you need to manage, focus on the areas on, and use your numbers as a guide each and every month of what you need to do and focus on and work on. How the cash flow moves in your pharmacy, so on and so forth. The fundamentals are vital, and without it, you can't do anything we're going to be talking about today. And we see a lot of pharmacy numbers, and we get a lot of we have RX assessments where we do kind of a check under the hood service. It's a one-time service, a check under the hood. And when people come and do that, a lot of times they know something's not right. And if you know in your gut something's not right, it's not going to be right, because when you have good numbers, you know it. But a lot of times the fundamentals aren't there. And so, they don't have receivables on the books, or inventory's never been adjusted, or there's outstanding checks, or equity doesn't reconcile to the tax returns. I mean, the list goes on. And so there's no fundamentals there. They're operating without really knowing what's going on. And you can't do that in today's marketplace of pharmacy, because we're dealing with margins that are very, very slim. And there's no room for error in a pharmacy. And if you do slip up in pharmacy, it's quick where you're going to be in trouble fast. So you got to have these numbers to stay on top of this stuff. It's just vital. Obviously, it's important for outperforming industry averages. Real-time information allows you to be the proactive. Those trends, strengths, and weaknesses, it's going to highlight those. It's going to allow you to focus on those areas and know what's going on. We've talked about the tax planning and mitigation side to it. And when you have these good numbers and you know what's going on, you know what you're focusing on, that allows you to focus on the patient care and growing your pharmacy. And that's, obviously the most important piece here. So let's see. So I've kind of gone over all that. Let's see. All right. So the balance sheet is where you're going to really start here. When we talk about fundamental accounting, okay, what is fundamental accounting? Well, you want to start with the balance sheet. You pull up your balance sheet. Maybe it's at the end of last year, 2024. You'll pull one up for, let's see, September 30th. So you always want to pull up kind of end of the month. And the balance sheet's a snapshot in time. Shows you your cash, receivables, inventory, your fixed assets, equipment, vehicles, things like that. Then it shows you your liabilities, any bank notes, any credit cards, what you owe the wholesaler, and then it shows your equity. And so what you want to do is you want to go line by line down that balance sheet, and you want to question every number on that balance sheet. And so you got cash at $220,000. Okay, well, how accurate is that number? Has it been that account been reconciled? Are there outstanding checks? We just onboarded a client here recently, and he felt like his sales were overstated. Well, they were in years past, because the accountant was doubling the sales from the sales receipts and the deposits that were coming in. So they were double sales going on. The reason they were never caught is because there was never a reconciliation taking place. And so he was paying tax on this income that wasn't there. So, again, going line by line down that balance sheet, receivables, do you even have receivables on the balance sheet? Is inventory accurate, or is inventory the same number that it was 5 years ago? Do you have liabilities? Is your wholesaler payable on there? That's what you owe the wholesaler at the end of the month, so on and so forth. So, and of course, you want to focus on that equity position as well, the equity portion of your balance sheet. And what you're looking for there is, does my equity that I'm showing here match my tax returns? And if not, there should be an explanation as to why. And if there's not an explanation, that means you have two sets of books going around. Your CPA's got their adjustments and what they're doing, but it's never made it back on your set of books. So you don't need two sets of books. You want one set of books. So those are just kind of the things you need to do from the start for determining those fundamentals in your accounting. The reason being, you start with the balance sheet because a lot of the things on the balance sheet impact the profit and loss. The bank accounts, obviously, the receivables, the inventory, the payables, what you owe the wholesaler, things like that. That impacts your profit and loss here. So you can see accounts receivables, revenue, inventory, cost of goods, so on and so forth. So as as you're reviewing this, how accurate your balance sheet is going to determine how accurate your P&L is. And, we're talking about key performance indicator in a pharmacy. Your gross margin, which is revenue minus cost of goods, is what we feel is your number one key performance indicator. And so if your accounts receivables off, or you're not booking it, or your inventory's way off, your margin's going to be way off, and the number one key performance indicator for you is going to be off. And that's, again, the number one performance indicator. You need to know exactly where you are from a margin perspective. So, these are just important kind of fundamentals you got to have in place to make sure you're staying on top of this stuff. Now, there's two main accounting methods that you need to be aware of in pharmacy. There's the accrual method and the cash method. So the accrual method is going to be when you adjudicate that script, that is income under the accrual method because you're booking a receivable. All right, the PBM, the third parties owe me, $100 for this script. That's a receivable, and then that's revenue. So and the same thing can be said for the expense side of it. A plumber comes and fixes something, when they fix it, when they invoice you, that's an expense, even though you didn't pay it for 30 days later, but it's an expense in the period where they, invoiced you there. So, from a financial performance perspective, month in, month out, reviewing your numbers, you want to be on the accrual method because it shows you accurately what's actually going on that month. And I know there's some Rite Aids that have been closing around the country, and we've seen huge volume of script increases at some pharmacies, but you got to be careful about what scripts you're bringing in there. But we're seeing some big volume increases under the accrual method. You're going to see that happen like in real time each month. Whereas the cash method, you're going to have a big lag there because the cash method is only going to be picking up income as that money's coming in the bank account, which could be 21, 30 days later for some receivables. So accrual method for financial performance for your books. Now, for the cash method, when we get into the tax side of things, you certainly probably want to consider the cash method of accounting for your tax return. And at the end of the year, you just do a switch. I mean, we have a reconciliation process we go through with that. But you pretty much just switch your books, cash method for the tax return. But the cash method gives you control for some tax purposes. So in other words, you can control your income a little bit better under the cash method because, hey, you got a bunch of expenses due in January. Well, hey, push those into December, pay them now, reduce your taxable income for the current year by paying them in December. So you can control your income a little bit better with the cash method. Not to mention that when you do go from accrual to cash method for tax purposes, that there could be a big tax benefit there, which is a tax deferral strategy. But when you're writing off receivables, well, that's a big number in most pharmacies. And when you write that off, that's a big number. That's a big tax deduction. So we still see some pharmacies on the accrual method. This was the cash method is more or less allowed for most pharmacies with gross receipts under $30 million. So most pharmacies should probably be considering that cash method. If you look at your business tax return, your partnership, or your S corp tax return, you should see on either page 1 or page 2, if you're cash or accrual, there'll be a little box checked. So just something to think about for tax, and we'll get into that a little more here in a minute. But and I know I cover a lot because there's just a whole lot to cover in a short period of time. So I apologize if I'm kind of breezing through this stuff. But if you have questions, I love questions. Just feel free to shoot those out, and I'll get to them. All right, understanding key performance indicators here. So the current ratio is kind of this, there's not a pharmacy, every single pharmacy I look at the current ratio. And that's a balance sheet ratio, and that's your current assets divided by your current liabilities. And this gives you an idea of the liquidity strength of the pharmacy. You want to be at 2.5 to 1. So $2.50 of cash receivables inventory for every $1 of current debt. And notice how I said current debt. How you classify those items on the balance sheet is important. If you have long-term notes, you need to make sure you're showing current portion of those notes in the current debts section to get an accurate current ratio. So just point that out there. So, but again, cash receivables inventory for every $1 of current debt. So $2.50 here. That's kind of your goal. 2 to 1 is okay, but anything below 2 to 1, you're probably sweating when the wholesalers come and due. And then that opens up a whole nother line of questioning. Well, why is our current ratio below where it should be? And then let's go and identify these issues. And so this is how you kind of start, like, hey, where am I? I'm not where I should be. Why? Okay, let's start digging some more. So I love that current ratio. The average inventory turn should be greater than 20, with technology, next day ordering, and $100 bills on the shelf, you need to be at 20 turns plus. Outstanding AR third party, we see 14 to 21 days, sometimes 25, 26 days, depending on which state you're in, but that's about average there. Equity to assets, 40 to 60%. So this is an equity position. How strong is your balance sheet from an equity point of view? If you're a mature pharmacy, you want to be in that 40 to 60% range. If you're below that, it's not necessarily a bad thing, but you need to have an understanding of where you are in your pharmacy life cycle and where this equity position is and whether it makes sense or not. A good, strong equity position can help you leverage your pharmacy or provide any other types of planning or benefits in your strategic planning. So equity to assets is a good one. Now, the gross margin, I mentioned that's the #1 key performance indicator on the profit and loss here. And that right now in the current environment is about 16 to 19%. And the pharmacies that are above 19% are doing those diversified revenues, and they're doing them really well, and they're doing them kind of all in. So those pharmacies are kind of exceeding some of these averages here, 20, 21, 22, 23% margins. But 16 to 19% is more or less where you should be from a gross margin perspective on your prescription fills. If you're below 16%, not necessarily a bad thing if you below 16%. So, we have some specialty pharmacies out there. We know they're at 10 or 12% margin, and that's their business model. And it is a different business model. If you're running margins below the 16%, it's a little bit of a different business model. Not much, but it is a different model and different analysis and insights as you review your numbers there. But, for, again, retail, you should be in that 16 to 19% range. Let's see, your payroll, the NCPA average is about 10%. We've seen this number drop, and that's a good thing. We're seeing pharmacies, change and evolve in the payroll area, whether that's more technology, whether that's, fine tuning the hours or how they're, paying their staff or, giving their staff some benefits and things like that. So about 8.5% to 9.5% is where you want to be for retail. I like that 8.5% mark for your pharmacy in general, and that's 8.5% of revenue, and that includes your gross wages. So if you're paying a pharmacist $120,000 a year, that's the number you're using in this calculation. It does not include payroll tax. It does not include benefits. This is just gross wages to your staff. 8.5% is my target. We have pharmacies in the 5%, 6%, 7%. So it's, there's pharmacies out there that are, how they do it, that it's debatable how they do that. They have different ways of doing it, but I'm telling you, some are doing it down in those lower percentages, and that does include the owners. If you're in the double digits with the payroll, you got a big problem. You can't do that in a 16 to 19% margin and have any bottom line. That's just it's not gonna work. So shoot for that 8.5% if you can here. The overhead is percent of revenue, less than 6% for sure. And that's just essentially, you take your total expenses, you back out your payroll tax, depreciation, amortization, things like that, interest. And that gets you kind of an idea of all your other expenses. Like at less than 6, 4% is a good number, really, for your overhead. And most pharmacies don't have problems with overhead at all. It's very rare where you're going to see a pharmacy that's just out of line on certain kind of overhead expenses. At the end of the day, it's going to be your margin. It's going to be your payroll that's going to drive your profitability one way or other. So, that's where you need to be focusing your time. And then the bottom line, about 3 to 6%. So 3%, 3 to 4% is a good bottom line number. Obviously, if you can get higher than that, that's great. But that's kind of where you'd want to be. Right. And Austin, if you see any questions, just shoot them out to me, please. Okay. So again, KPIs help you know where you are, what areas you need to focus on. Why is my margin below where it should be? Is there, what scripts am I filling? Am I still doing GLPs? It starts opening, allows you to start asking questions and digging into where something may not be right. So that's what you got to do. It's a puzzle, and you got to use your accounting to help you figure out the puzzle. Okay. All right, so we're going to get into some tax things now. So like I said earlier, the Tax Cuts and Jobs Act of 17 was set to expire at the end of this year. So next year we would have, pharmacies are already on that thin margin. Cash is king. Boy, I'm just thankful that we've got some tax relief now with the One Big Beautiful Bill, because it's been really bad for pharmacies. So we had this new bill, and a lot of the Tax Cuts and Jobs Act, a lot of those areas were extended, and there were some additional areas added as well, and we're going to touch on those things that will matter to you. And so, a lot of IRS clarity is now needed in terms of, what some of these new things mean. So we're waiting on that. Of course, the government shutdown is going to delay that probably even more. But that's just the way it is. And you got to watch out. I'm already seeing some bad advice or bad, false tax summaries from some pharmacy folks out there. And what they're doing is they're using maybe ChatGPT AI, and it's using the House bill that never even passed as part of its of what it's telling you. So be very careful of what you're reading online, because a lot of that's maybe coming from some like AI generated content, and that content may not be pulling the actual UBA bill, which I have seen. So be careful out there. So again, we're seeing individuals at all levels seeing tax breaks here. Some key areas: qualified business income deduction, R&D tax credit changes, state and deduction changes, pass-through entity tax changes, depreciation, some manufacturing and nexus issues. So we're going to dive into some of those here. I mentioned the diversified revenue, so we've kind of already covered that, but those are some of the ones we're kind of seeing right now before we get into the tax. Again, those 340Bs can be very, very lucrative for pharmacies if you get the right contract. So you got to be very careful with those. So we have the permanent, these tax brackets now are permanent. So that 37% top tax bracket, these are permanent now. So we like permanent in the tax world. We know what we're dealing with. We know what the rules are with permanent. So it would have gone to almost to 40%. So we're at that 37% top tax bracket. So that's good. The standard deduction is increased. Again, this is indexed with inflation. It's made permanent here. And most taxpayers, most of you on the call here will probably take this standard deduction here, which is 31,500 married filing joint. Itemized deductions, your Schedule A deductions, still important part of your planning, should be part of your planning. If you're going to be doing some charity planning for your situation, or you have maybe a lot of interest, or some are in a higher tax state, you may be I imagine this percentage might be coming down a little bit, but if you're in a higher tax state, you might be in that itemized deduction level here this year and maybe in the next few years, because they did change some things on the itemized deductions. So there's going to be a limit on your itemized deductions starting next year. So, this is where the planning is going to be very important. And so, if you're going to be in that top tax rate, you may be seeing some limits with some itemized deductions. So you absolutely need to consider this, because it can wipe out your itemized deductions if you don't plan appropriately for this limitation. So this is something for, if you are a very profitable pharmacy, or maybe you're selling your pharmacy and you're going to have a big windfall of some cash, some gains, some capital gains, ordinary income, and you're going to be in this top tax bracket, and you're kind of want to find some strategies to reduce some of that tax and things like that. Be aware that if you're in that top tax bracket starting next year, that there is a limitation here. So this should be part of your planning if you are in the top tax bracket. Not going to get into very more specifics here, but you do need to be aware of that. Okay, the qualified business income deduction. Now we see this was part of the Tax Cuts and Jobs Act, and what this does is those pharmacies that are pass-through entities, that are partnerships, S corporations, not C corps, but partnerships, S corps, sole proprietorships. What this does, this is intended to do, was it was meant to get your business income tax rate down to a level that's close to the C corp tax rate, which is 21%. So the C corp rate was dropped to 21%. So they were like, all right, well, we need to throw this deduction in there for these pass-through entities so we can make this tax rate a little more comparable for these other businesses. And so here comes the QBI deduction. Now, if you read the law, it says a pharmacist is a specified service trade or business, SSTB. And so we see CPAs miss this all over the country because they read that, they mark the pharmacy as a SSTB. But if you go into the regulations for 199A, the final regs, you will find where we and the NCPA and others wrote the IRS and said, hey, IRS, a retail pharmacy selling prescriptions should not be an SSTB. And the IRS, pretty much word for word, says we agree. So that gets missed quite a bit. So you want to make sure, and there may be instances where you are an SSTB. So let me be clear about that. There may be an instance or two where you could be an SSTD, but in general, a pharmacy in the retail space is not. So you need to check your tax returns and see if you are marked as an SSTB. So on S Corp or partnership, you'll look at your K1. You'll go to the 199A section, probably page 2 or 3 of the K1 form, and you'll see the 199 area. And there should be a box that says SSTB, and you'll see if that's checked or not. But it really comes down to, was it marked that way on your individual tax return? I believe it's line 13 of your form 1040, page 1, which you want to look for. So just be aware, because we still see pharmacies miss this, and this is a lot. This can be 6 figures for some of you out there in terms of tax. These are big numbers, and if you've been, I saw one a couple weeks ago. They've been marked SSTB. They've been missing this. They've been in a higher tax bracket, so they've been limited to the fullest degree. They've been missing this since 2017, and they've been paying that extra tax they shouldn't have been all those years. So just double check if you are taking advantage of 199A. Probably a good chance you qualify as a not an SSTB. Now this is permanent, so this is great news. And again, this does not apply to C Corps. And there is planning you can do to maximize the qualified business income deduction. So, that's something to put in your mind. So a little more technical for this conversation, but there is some planning to do here. Research and development. So there's some changes here. So the R&D tax credit is certainly something pharmacies can look at taking advantage of. The key thing here is documentation. And, if you don't have the documentation, it's going to be hard to claim the credit. But what I recommend is pharmacies, this is where AI is a great tool. You can go in there every day and say, I'm a pharmacist. I'm working on, developing some clinical services and this and that. And this is what I did this week. And this is how much time I spent on it, and da-da-da-da. And you tell it you're trying to qualify for the R&D tax credit, and it'll push it all out into a documentation format that will pretty much check the box for contemporaneous documentation for the IRS. At the end of the year, you take all those, you add it up and see if you can get the tax credit. So AI definitely is going to help pharmacies in this area take more advantage of the tax credit. But the R&D expenses side of it is a different area of the code, and that's no longer an issue. I'm not even really going to talk about it, but there was a period of time there where R&D expenses had to be capitalized and written off over a period of time. That's now no longer the case. So it was a tax increase, really, is what it was. Congress was supposed to fix it with the Tax Cuts and Jobs Act. They never did. But now it has been fixed retroactively in the new bill. So I guess if you were, maybe you're a compounder out there and you had a lot of R&D expenses, if you were capitalizing those, just know now you can, that has been reversed, and there's ways about going to reverse that on your tax returns. But it does make the R&D tax credit more attractive now. State and local tax, so SALT. If you're in a high tax state, this is going to be a key planning area, because you're paying a lot of property tax, you're paying a lot of state income tax, things like prior to the new bill, as of right now, or as of last year, and prior, your state and local tax deduction was capped at $10,000. Previous to Tax Cuts and Jobs Act, there was no limit there. So that's capped at 10,000, and that's why you saw so many individuals, taxpayers, go into the standard deduction, because a lot of itemized deductions come from state and local taxes. So what this new bill does is it increases that cap to $40,000 beginning this year. It does phase out. So if you're over, $500,000 of modified adjusted gross income, that starts to phase out. So it gets into the next point here is the pass-through entity tax. So as you're going through your planning and you see that you're going to be in you're going to have some excess state and local taxes, whether it's property tax or income tax, what have you, from your states. And you're going to have limits there because maybe your adjusted gross income is very high as well. Well, there's ways to get around that limitation, and that's through the pass-through entity tax. And we saw a lot of pharmacies, well, I know we did here, with the $10,000 cap. Most of our pharmacies, we had them do the pass-through entity tax election. And what that is the pharmacy pays the state tax at the pharmacy level. And the pharmacy deducts the state tax that the pharmacy pays. And so that lowers your taxable federal income. And so you're circumventing the $10,000 cap, and you're lowering your taxable income through the pharmacy. And so that was kind of an automatic for a lot of pharmacies. And that's changed now, with the SALT cap being changed to $40,000. But it is going to require planning. And because if certainly if you're in these higher income brackets and you've got a big year and, you're in a higher tax state, even other states, but particularly higher tax states as well. Hey, maybe you do need to do the pass-through entity tax election to get those deductions passed through to the federal side. This is still in the law. This is perfectly fine. But do know this is an option if you're running into state and local tax issues in terms of deductions. Okay. Section 168K, bonus depreciation. So, you hear a lot about bonus depreciation. Section 179, they're more or less the same. I mean, there's some differences, but 100% write-off essentially is what we've got now. It was 40% prior to the tax bill. Now it's 100% deduction for qualified property acquired on or after 1/20/2025. And that date's important. So essentially, robots, improvements to the internal improvements, new fixtures, a clean room or whatever, what have you. 100% write-off for these capital expenditures now, and this is permanent. So this is fantastic. I mean, so from a planning perspective, essentially anything you're going to need equipment-wise or improvement-wise, things like that, you're looking at 100% write-off instead of the 40%. It was going to go to 20% next year and so forth. So this is fantastic. So as you're going into your planning this year, do you have equipment needs? Is there anything you need to spend money on? We don't want to spend money just for tax benefits. You want to spend it for, the economic reasons first. But if there's anything, do know that you're going to get 100% write-off. And if you're in a top tax bracket, we'll just say 35%, $100,000 expenditure, is a $35,000 tax benefit. So your net cost is what, 65. So no dollar cap here either. So good strategy to just always have in the back of your mind here. Section 179, like I said, very similar to bonus, but with bonus, here's the thing: if you're a multi-store owner, maybe you've started a new pharmacy, you've got some losses. With bonus, you can create losses. Section 179, you can't necessarily do that. So So the bonuses are great planning tools as well, where you can accelerate losses to offset other income of other areas. Maybe you're W-2 or you have another business with income. So bonus is a good, powerful planning tool from that perspective. The other thing I'll say about bonus depreciation now is that if you own the pharmacy building, a building is written off over 39 years. And that's a very, very long period of time in the tax world. So your return there is not very good. What you can consider, usually with buildings over $500,000 or so, is a cost segregation study. And what that does, that goes into your building and it breaks down that building into component parts, fixtures, lighting, flooring, things like that. And it takes those items, and those items have shorter depreciable lives in the eyes of the IRS. And those shorter depreciable lives qualify for bonus depreciation, 100% write-off. So if you own the building and it's generally over $500,000, you should consider a cost segregation study. Even if you've already had the building in use for 5-10 years, you may be able to go back and recoup depreciation you otherwise were entitled to take. So cost segregation studies can be great planning tools as well, especially if you're buying a building in today's market for your pharmacy. Again, planning very important. Usually those buildings are in separate LLCs. Usually you have some limitations on losses. You have to plan on how we're going to, how can we get around those limitations? Does it make sense to do this, so on and so forth? But, a lot of instances, it's a great tax planning tool. Another one here that this one slides under the radar all the time is the nexus. And, we see this a lot in compounding, especially with the GLP-1 craze that was going on, where pharmacies were shipping out of state. And, when you ship out of state, those other states, well, they want to know what you're doing. They want you to report sales tax, even though a lot of prescriptions aren't taxable. They're still going to say you still have to file, even if it's a zero return. They still want you to file sales tax in a lot of instances if you meet the thresholds, and they still want you to consider income tax as well. And so if you're doing multi-state sales, or you even have marketing folks going into multi-state, you need to be aware of nexus issues for sure. You do not want the state to come and say, oh, you should have been filing this and that for the past 5 years and you weren't doing it. And, the states are not going to, they're not going to negotiate with you. They're just going to hit you right there. So you do need to be aware of multi-state issues if that's what you're doing. And it can actually work to your benefit. Another state I got to pay income tax to, in some instances, it can actually benefit you and create you to pay less tax because of the way some states handle multi-state sales. So just be aware here about what's going on, and especially if he's got some nexus issues. This is a tricky area you got to be aware of, because you got bunch of states, and every state has a different set of rules, every one of them. So be aware of that. Now, I'm not going to spend any time on this really. This is for 503Bs. If you're a 503B or thinking about 503B facility, there's now a manufacturing benefit where they want the government is going to allow you to write off. I mentioned the building 39 year. Well, if you're doing manufacturing, they may even allow 100% write-off of the building in year one. So when we talk about the administration, wanting to bring back manufacturing, this is a big one they're trying to do here with this aggressive write-off of these manufacturing facilities. But again, most pharmacies, not an issue here. I don't see it anyway at this point. as they come out with the guidance, we'll be taking a closer look. But right now, 503Bs, this should be on your radar. All right. So we've got some diversified revenue. Let's see. Austin, are you there? You want to walk through this one with me?
Yeah, I'm here.
Sure.
So basically this is just some practical items. You know, we talked about the tax stuff. These are just some things to consider when you're diversifying revenue, some things that we talk about with different clients. You know, obviously you want to make sure you want to look at the market that you're in, seeing if that revenue stream makes sense. List out, you know, pick 1 to 2 revenue streams that are impact, very low barrier entry. Next step is ensuring you have those fundamental accounting and KPIs in place. And then from there, you want to, you know, understand and consider the tax impacts once that revenue stream is up and running. So those are just kind of like some practical steps there. And Scotty, I don't know if you want to elaborate a little bit more on any of those, but those are just some conversations when we're talking with clients and things that are some steps to take.
And so, you know, we've mentioned some of the things on, you know, getting into diversified revenue. What does that mean? You know, increase in top line revenue. What does that do to margin? How is that impacting margin? Are we investing any capital in build outs? Is it multi-state? You know, you can see where you start doing things. Well, there's going to, you know, there could be some tax implications all the way around for a lot of these things. Innovation, process improvement, R&D tax credit, multi-state expansion, any nexus issues, operational deduction. So part of your kind of year-round planning, you got to be tying the stuff all together is what we're trying to get to here. And this is just an example: compounding lab build out, bonus depreciation or 179, gross margins increase, higher net income, can impact the QBI deduction. You know, your wages impact the QBI deduction. How should we be handling the owner's wages? You know, are there any R&D tax credits that we can find for getting involved in this new area? And the R&D tax credit, when you're talking about that, it's, you know, there needs to be uncertainty. There needs to be a process of experimentation. It needs to be technological in nature, and it needs to be a new product or process. So if you're meeting any of those things for whatever you're working on, well, you have to meet all 4. But if you're meeting that for whatever you're working on, you know, you might have some research and development going on in terms of what the IRS considers R&D, and just keep a diary, keep some notes. So maybe you can get some tax credit out of it. And tax credits are great because it's like you're writing a check to the IRS. So you get the deductions for all these expenses, you know, but you can get a credit on top of it. I also want to mention about the Schedule C taxpayers and partnership pharmacies out there. You know, if you're a Schedule C or a Schedule C sole proprietor pharmacy or a partnership pharmacy, and you're profitable, you know, you need to be aware, you know, you may be paying some excess self-employment tax, and I can't stand the excess self-employment tax. So it's just excess tax that really doesn't need to be paid if you just had the right entity structure. I mean, maybe a partnership's the right structure for you. Don't get me wrong here. There's reasons you need to be a partnership, but a lot of reasons why you shouldn't be as well. And self-employment tax is one of them. So be aware of the self-employment tax trap for these partnerships and Schedule C sole proprietors. The S corp structure can kind of mitigate a lot of that additional tax from the self-employment tax there. Well, that's a lot of information. In fact, I've got 5 more minutes, so I'm going to now you have Trump accounts for children. what a strategy you can consider if you have if you have kids, children, if you can justify their salary, pay them out of the pharmacy, and they obviously they need to be doing work. You need to be able to justify what you're paying them, but pay them out of the pharmacy up to $15,000. Do not withhold federal tax. They don't have to pay. They don't have to file an income tax return. Now you got to check the state. There may be some state rules, but from a federal perspective, $15,000, no federal withholding. There's no tax return being filed. So that's a way of moving $15,000, out of the business, pretty much tax free. Then you take that $15,000 up to the, once you go above 15, this you got to file the tax return. But then you take that 15 that's your child earned, and you put, the max into the Roth IRA. Could be $7,500, I think, is the max now. And now you got a Trump account that you can put monies into. And so, the children planning here is a big area of opportunity. If you're looking for any, kind of, I guess you would call it estate planning with children type thing. And so, the government, and if you're having children now, the government's going to put $1,000 into that into a Trump account for you, every child in this country, being born as of, I believe it's the beginning of this year. And that's a big deal because, by the time that $1,000, they're 65 years old, that I've seen where, it could be worth $600,000, $700,000. And so these children that otherwise don't have anything are now going to have, a nice chunk of money in a Trump account just from $1,000 the government gave them. So these are some powerful things to be considering in your planning, for sure. And the child tax credit has increased as well. I believe it's $2,200 now. And so, as you're doing planning, and you're right on the cusp of qualifying for the child tax credit. And maybe, see, this is where your cash basis accounting method for tax purposes can come into play, because say you prepay $20,000 of expenses, that might push you down into a lower AGI threshold, and then you get $2,200 of tax credit from the government just by moving some money around. So, these are where the planning things can be so valuable, as you look going into this year. So I know I've kind of gone on and on here. It's a lot of stuff. I get a little excited, so I appreciate you guys listening in. If you have any questions, I'm happy to take any emails. We can get right back to you. I'll try my best to get right back to you. But otherwise, thank you, Nathan, American Pharmacies, for having me today, and I hope everybody has a great rest of their day. Nathan, I'll pass it over to you.
All right, we appreciate it, Scotty. A lot of information, a lot to digest here, but I think it's pretty clear. You need to be getting some sound advice. You need to understand your KPIs and where you are, figure out how you want to allocate your time, and put together a plan with your accountant, because there are some benefits out there, and you've got to be strategic, especially in today's market. So really appreciate your time. I don't know, Austin, if there's any questions. If anybody has some, include them in the chat, or like Scotty said, you can email him at that email there on the screen.
Yeah, and going back to those KPIs, Nathan, I will say the American Pharmacy KPIs are on that higher end range, the 19+%. So, I guess I should have been more specific in my KPI discussion here, but American Pharmacies, you guys are in the top range, from what I see. So, everybody listening on this call's in good hands here with American Pharmacies.
That is excellent to hear. Thank you for sharing that.
Yep. So again, any questions? Happy to take them. Otherwise, we will please reach out to me, and I'm happy to get back with you.
So Debbie asked, how can we access the recording? I'm sending Jeff and Nathan the recording after this call, and they will send it out to you. You'll have access to it.
Okay,
All right, I
gentlemen.
guess I scared everybody. All righty. Well,
Yes. Well, thanks to you, Scotty, and Austin. You've been great to deal with, and I appreciate you setting this up for us. So thank you.
all right. Thank you,
Absolutely.
Nathan. Thank you, everybody. Take care.
Take care, guys.